The 1929 crash versus 2008 crisis, different numbers, same fatal mistake. Imagine waking up tomorrow and discovering that 47% of your retirement savings is simply gone. Not stolen. Not hidden. Erased by the market itself, overnight. That's not a hypothetical. That's exactly what happened to the average American 401k between October 2007 and March 2009. And here's the part that should genuinely unsettle you: America has lived through this nightmare before. In 1929, the Dow Jones lost nearly 90% of its value over 3 years. In 2008, the S&P 500 lost over half its value in 18 months. Different decades. Different technology. Different generation of investors. But strip away the headlines, and you'll find the exact same financial blueprint underneath both disasters. Understand this pattern, and you'll start noticing it everywhere, including possibly right now. Most people file 1929 and 2008 into completely separate mental boxes. One is black and white photographs of bread lines and men in fedoras. The other is CNBC anchors shouting over falling stock tickers and families losing homes they just refinanced. They feel like different worlds. But economists who study financial history point to something uncomfortable: nearly every major crash follows an identical 5-stage sequence. It doesn't matter if the asset is tulip bulbs, railroad stocks, dot-com companies, or mortgage bonds. Today, we're going to walk through that sequence using America's 2 biggest financial catastrophes, with real numbers, real consequences, and the warning signs economists say are still relevant today. Every bubble starts with a sentence economist John Templeton called the 4 most dangerous words in investing: "This time is different." In the 1920s, America was electrified, literally and figuratively. Industrial production nearly doubled. Radio ownership exploded from almost nothing to over 10 million households. The Dow Jones Industrial Average roughly quadrupled between 1921 and its 1929 peak, climbing from around 60 points to 381. Ordinary Americans, shoeshine boys, secretaries, taxi drivers, started buying stocks. Not because they understood the companies. Because everyone around them was getting rich. Now fast forward 75 years. The dream shifted from Wall Street to Main Street, specifically, to the house on Main Street. Between 1997 and 2006, U.S. home prices rose roughly 85% nationally, adjusted for inflation, the steepest sustained increase in American history. Banks didn't just lend to qualified buyers. They invented entire categories of loans: ninja loans, no income, no job, no assets required, built on a single assumption: home prices only go up. Once again, an entire country convinced itself the old rules no longer applied. Every bubble needs fuel, and that fuel is always the same: cheap, abundant credit. In the 1920s, investors could buy stocks on margin, putting down as little as 10% of the purchase price and borrowing the rest. By 1929, an estimated $8.5 billion was out on margin loans, more than the entire amount of currency circulating in the United States at the time. It worked beautifully on the way up. A 10% rise in a stock could double your money. But the same leverage that multiplied gains also multiplied losses the instant prices reversed. In the 2000s, the leverage moved into mortgages. Investment banks didn't just originate risky loans, they packaged thousands of them into mortgage-backed securities, then sliced those into complex products called CDOs, often leveraged 30-to-1 or more. Credit rating agencies stamped many of these AAA, the same rating as U.S. Treasury bonds, despite being built on loans to borrowers who, in many cases, couldn't realistically repay them. More borrowing pushed prices higher. Higher prices justified more borrowing. It was a feedback loop with no brakes, until the road simply ran out. October 24, 1929, a day now known as Black Thursday. Nearly 13 million shares traded in a single session as panic selling began. 5 days later, On Black Tuesday, the market lost what would be equivalent to roughly $14 billion in today's dollars, in one day. Margin calls forced investors to sell stocks just to cover their loans, which pushed prices down further, which triggered more margin calls. By 1932, the Dow had fallen 89% from its peak. It wouldn't fully recover until 1954, 25 years later. Now jump to 2008. Housing prices peaked in 2006 and began a slow, then accelerating decline. Subprime borrowers, those ninja loan recipients, started defaulting in waves. The mortgage-backed securities built on those loans, supposedly rock solid, turned out to be nearly worthless. On September 15, 2008, Lehman Brothers, a 158-year-old investment bank, filed for the largest bankruptcy in U.S. history, with over $600 billion in assets. Within days, credit markets that keep the entire global economy functioning simply seized up. Financial crises rarely destroy economies through numbers alone. They destroy something harder to measure: trust. In 1929 and the years following, roughly 9,000 American banks failed as depositors rushed to pull out cash, fearing their savings would vanish, which, without deposit insurance at the time, they often did. In 2008, the panic looked different but moved just as fast. Banks stopped trusting each other enough to lend overnight, even for routine transactions. The interest rate banks charge one another spiked dramatically as institutions hoarded cash. Credit froze. Businesses couldn't make payroll. Unemployment in the U.S. climbed from 5% in 2007 to 10% by October 2009, a loss of roughly 8.7 million jobs. Different mechanism. Same emotion. And once fear takes hold of a financial system, even fundamentally healthy businesses get caught in the wreckage. Here's where the two crises genuinely diverge, and it matters. After 1929, government intervention was slow and, by most modern economic analysis, counterproductive. The Federal Reserve actually tightened the money supply. Congress passed the Smoot-Hawley Tariff Act, which most economists agree deepened the global downturn. Unemployment didn't peak until 1933, reaching nearly 25%. By 2008, policymakers, many of whom had studied the Depression specifically, moved with unprecedented speed. The Federal Reserve cut interest rates to near zero and launched emergency lending programs. Congress passed the $700 billion Troubled Asset Relief Program within weeks of Lehman's collapse. Whether those bailouts were the right call is still debated fiercely today. Some argue they rewarded the same reckless institutions that caused the crisis. But the recession that followed, while severe, lasted 18 months rather than years, and the recovery began far sooner than in the 1930s. Look closely, and both disasters followed an identical sequence. Innovation creates genuine excitement, easy credit accelerates it, asset prices detach from reality, debt reaches unsustainable levels, confidence cracks, and panic does the rest. This cycle didn't start in 1929, and it didn't end in 2008. You can trace the same pattern through the 2000 dot-com crash, the 2021 meme stock and crypto mania, and arguably parts of the AI investment surge happening right now. Markets change. Technology changes. But human psychology, greed during the climb, denial near the peak, panic on the way down, has remained remarkably consistent for centuries. The biggest lesson from 1929 and 2008 isn't simply that markets crash. It's that every generation convinces itself it has finally outsmarted financial risk, right before reality proves otherwise. Bubbles never begin with panic. They begin with confidence. They're fueled by easy money. And they survive as long as enough people believe the most dangerous sentence in finance: this time is different. History suggests the numbers will keep changing. The technology will keep changing. Human nature almost never does. If this deep dive into financial history was useful, subscribe for more breakdowns of the crashes, companies, and economic decisions that shaped modern America, because understanding the past might be the smartest investment you make all year.